Are you still not profitable in your trading journey? Then you might be one of the 95% of traders who are making costly mistakes.
Revenge trading, the get-it-back syndrome. You are trying to punish the market after a loss. This usually leads to doubling the position size and blowing the entire account by 3:30 p.m. Overtrading occurs when a trader enters too many trades in a short period, often exceeding their financial capacity or deviating from their established strategy. It is commonly driven by emotions like greed, the need to recover losses, revenge trading, or a simple addiction to the rush of the market. In the world of the 95% of retail traders, overtrading is one of the fastest ways to blow a trading account. Catching the top or bottom is a high-risk trading behavior where you attempt to predict the exact price point where a trend will reverse. Instead of following the established momentum, you bet that the market has gone too high and must fall, or too low and must bounce. In trading circles, this is often compared to trying to catch a falling knife or standing in front of a freight train. FOMO, or fear of missing out, is one of the most destructive emotional triggers in trading. It occurs when you see a price moving rapidly, usually without them, and feel a desperate, panicked urge to jump in to avoid being left behind. In the market, FOMO is the bridge between a pro trader and an amateur. In trading, greed is your intense, irrational desire to extract more profit from the market than a logical framework allows. It is just the opposite of a disciplined exit strategy. While fear keeps you out of good trades, greed keeps you in bad ones for too long or pushes you to take dangerously large position. For the 95% of retail traders, greed is the primary reason why a green day, profitable, ends up as a red day, loss by 3:30 p.m. Now tell me honestly, how many of you face this problem in your life? System hopping is the chronic habit of jumping from one trading strategy, indicator, or one guru to another the moment a few losing trades occur. It is the shiny object syndrome of the financial world. Instead of mastering one method, the trader remains a perpetual beginner in 10 different ones. Today you're scalping, tomorrow you switch to swing trading, and the next day you call yourself an investor, without realizing that each approach is a completely different vehicle, demanding its own set of skills, strategies, and a serious investment of time to truly master. In the 95% of retail traders, this restlessness is the primary reason they never achieve a positive equity curve. Averaging down is the act of buying more of an asset as its price drops to lower the average purchase price. While this sounds like a bargain hunting strategy used in long-term value investing, it is a lethal trap for 95% of intraday and swing traders. In trading, averaging down is often just a polite term for fighting the market, because you refuse to admit your initial trade logic was wrong. In trading, a stop loss is a predetermined price point where a trader automatically exits a losing position to prevent further capital erosion. Trading without stop loss is like driving a car at high speed without brakes. It's not a matter of if you will crash, but when. For the 95% of retail traders, the absence of a hard stop loss is the important cause of a blown account. In trading, Having no plan or checklist is like a pilot trying to fly a commercial jet by feeling the controls instead of following a flight manual. You might take off successfully a few times by luck, but eventually, the lack of a structured process will lead to a catastrophe. For the 95% of the retail traders, the market is a place of random impulses. For the 5% of the traders, the market is a place where they execute a predefined business script. This is the original sin of 95% of traders. At Bossfyl Institute, we see this as the core reason why retail capital consistently flows into the hands of the top 1% of institutional players. The get-quick-rich trap. Most traders enter the market with a lottery mindset, not a business mindset. They don't see the Nifty 50 as a vehicle capable of delivering a disciplined till the 20% CAGR over time. Instead, they treat it like a casino, hoping to double their money by Friday. A generation ago, the stock market wasn't widely understood or accessible. Our parents had limited exposure, and for most, it wasn't even considered a viable profession. But over the last 2 decades, the market has evolved into a full-fledged ecosystem, a legitimate career and business opportunity. This shift has brought in a massive wave of new participants. But here's the problem. Most people enter without understanding how to approach the market. And even those who do often lack the right mindset. They know one thing: the stock market is a place to make money. What they don't fully grasp is this: 95% of market participants lose money. Only 5% manage to achieve consistent profitability. To be in that 5%, 2 things are non-negotiable. 1. Deep, structured knowledge. 2. A fundamentally reset mindset. Without these, the market doesn't reward participation. It punishes it. We are hosting an exclusive free stock trading and investing masterclass to reveal how to handle this problem.
Want access to our masterclass? DM us now and we'll send you the Zoom link. And yes, search Bossfyl Institute in internet and follow all of our social media.